Okay, one thing I think you will like about this chapter, current liabilities, is towards the end, we talk about payroll. And if you've ever had a job and gotten a paycheck and looked on that pay stub and said, where did my money go? This will help you understand where the money goes and how it's all calculated. Why does your gross pay get all these deductions? And then you end up getting a smaller amount, your net pay or your take-home pay, deposited into your bank account or in check form or however you get paid. So we'll learn about that, but that's towards the end of the chapter. So current liabilities. Oh, okay. Current liabilities. So we know what those are, right? You know, liabilities are debts. And current means they're due within a year, or if you want to get technical, within one operating cycle. We will learn to analyze, journalize, and report current liabilities. We will learn about contingent liabilities. What is the word contingent? What does that mean? For something to be contingent. Okay, it depends on something else. So it could be like a contingency plan as a backup plan, or a contingent liability would be if this happens, then we have a liability. So that would be a contingent liability. We will talk about short-term notes payable. We know that a note payable is a debt. It's a liability. But if it's short-term, that makes it current, right? Because it has to be paid back within a year. And then again, we will get to payroll. So current means within a year, meaning the debt has to be paid within a year, or it could be an operating cycle. And if you don't remember that term, it's how long it takes from the time a company buys its inventory, for example, sells it, collects the money from their customer, and then is able to repeat the process. That is one operating cycle. And if it's not a manufacturing company, then it's still the same thing. So from the time you provide the service, get paid, and then can provide another service is one operating cycle. So for some companies, it might be a lot shorter than a year, it might be longer than a year. And that's why, for simplicity's sake, we're just going to stick with a year, okay? To define what is current versus non-current. So a debt that has to be paid within a year is what we'll call a current liability. And then if it's a debt that's going to be paid after more than a year, it's non-current. What would be another word for non-current? Long-term, right? Okay. So what are some examples of current liabilities? Well, we know accounts payable would be one. If we have an account payable, who do we owe money to? A supplier, right? Okay. Unearned revenue. If we have unearned revenue, who is our liability to? What's that? The customer, that's right. And if we have a note payable that's long-term, but part of it is due this year, then guess what? That note, that loan, is long-term, but not all of it. The portion that's due after this year is long-term, and the portion that's due this year would actually show up as a current liability on our balance sheet. So keep that in mind. A note payable, one single note, could have both a long-term portion and a short-term portion. And taxes payable would be current as well. Governments want their money, right? They don't want to wait a year to get their money. What would be some examples of taxes that companies have to pay? What kind of taxes? Income tax, right? What else? Property tax, correct? Sales tax, payroll tax, and others. So there are quite a few different types of taxes. They all would be current, even income taxes. As individuals, we typically only have to send in a payment or get a refund once a year, typically. Although if you make enough money, the IRS might require you to do it quarterly. But businesses typically have to send their income tax payments in quarterly. A small business, maybe not, but the larger businesses for sure would have to send them in quarterly. So they would be current liabilities. All right, so we know what accounts payable are, right? We need to pay an account for a supplier. And the way it generally works is you need something from your supplier. Could be product, could be a service, could be raw materials, whatever it is. And so the supplier agrees to provide you with that. But in business transactions, they usually don't require that you pay upfront. Standard for business transactions that they say, okay, here's your product, here's your service, here's your invoice. And then they give you payment terms, right? We've seen those before, like a 210 net 30 or other payment terms like that. And so they give you time to make your payment. So guess what? You have a liability, right? You owe that money to them. So that's called an account payable. Here's an example of an invoice. So typically it's going to have this information on it. It will say that it's an invoice and it'll have a specific number. So the seller generates the invoice and they give each one a unique invoice number. So if you call them up and you have a question about your invoice, you can give them the invoice number and they pull it up in their computer. And they know exactly what you bought, who you are, right? Because again, it's a unique invoice number. The date of the invoice, which is important because they want to make sure you paid within a certain period of time after that date. Here's the company's logo and address. Here's you. You have to identify who it is that they're billing, what it is that you bought. So this was, I guess, stock item number. I'm not really sure what the SI stands for, but it's what product number of theirs you purchased. And here's the name of the product. You bought 10 of them at this price, which is this total. Shipping charges get added in. Here's a total amount. Here are the credit terms. Everything you need to know about that purchase. Remember, this is an original source document. So when you get that invoice, you can record it into your accounting system. And once you pay it, that would get recorded as well. And so you've got a record, they've got a record, everybody knows what transpired. Because while it might seem that one transaction is not that hard to remember, when a company is dealing with transactions every day, you're not going to remember the details, right? So having documentation is critical when you go back to make your financial statements, to prepare your taxes. If you're getting audited, you need to have that documentation, like invoices, so you know exactly what happened. So any questions or comments so far? All right, so what else? Unearned revenue, as we discussed, it means you owe money to a customer, right? No, I'm sorry, that's not right. You got money from a customer, you owe them the product or service. So I misspoke. But that's still a liability. You still owe them something. So here are some examples. If your customer signs up for a magazine subscription, they pay you before you send them every copy of the magazine, right? So if you're a publisher of a magazine and you've gotten paid by your customer, you have unearned revenue until you send them all of their magazines. every time you send one, that's a little bit of unearned revenue that goes away and a little bit of revenue that you earn until you've sent all of them. Gift cards. You go to the store and you buy a gift card, you've given them money, you haven't really received a product or service, right? The gift card itself is not really something you're going to use. It's basically you're converting your payment into another form of payment. So they still owe you a product. And when you go back to the store and you say, okay, I want to use this gift card now, then their unearned revenue goes away and they've made a sale. Same thing if you buy concert tickets, for example. You tend to buy those before the concert, right? So the concert venue or promoter has unearned revenue until they actually put on the concert. Lawyers will often charge an upfront fee called a retainer to cover their future work. Same thing. You pay them up front, they owe you the work, right? And let's say you pay a deposit for a service. Maybe pay a deposit for rent. Probably not the best example. Let's see, what would be a better example? Oh, let's say you order a birthday cake. It's going to cost $100. It's like a really fancy cake. And they require a $25 payment up front. And then the rest you'll pay when you pick up the cake. Okay, that's a better example because now you've paid a deposit that's going towards your product, but they haven't given you the product, right? So the baker has unearned revenue. So that's the same in all these cases. The customer pays before they get their product or service. And we know that revenue recognition principle says the company cannot count it as revenue until they've provided the product or service, right? So what they have to do, the company that accepted your money, they count it as unearned revenue. When they provide the product or service, they reduce the unearned revenue. They now call it revenue. So the liability goes away, and now they have a sale. So here's an example of that. It's a landscaping company, and basically, if you pay them, they're going to come 3 times and do landscaping work. So here's the deal. It's $120 if you prepay. So a customer paid. Now this is the company doing the accounting. So they're saying, okay, we received $120 in cash, but we haven't done the landscaping work yet. So we have unearned revenue, right? Then a couple weeks later, we've done some of the work. We did 1/3 of the work. So now $40 of that unearned revenue goes away with the debit, and revenue, it's a credit. Here they put earned revenue. You could do that, but you could leave out the word earned. It's really not necessary. It's assumed. If you're calling it revenue, it's assumed that you have earned it because that's what GAAP says. Then they come again a couple months later. They do another $40 worth of work. So again, the unearned revenue goes down and they count another $40 worth of revenue. Then they come one more time, another $40 of debit to unearned revenue and credit to revenue. So at this point, after April 1st, how much unearned revenue is on their books? If they had $120 credit and then 3 $40 debits to unearned revenue. 0, right? All that unearned revenue went away. And how much revenue is on their books? Exactly. Thank you, Romario. Also 120. They did the work, right? They earned everything that they initially got paid for. So it's not too hard, but that's how you journalize unearned revenue and then the subsequent revenue. Any questions or comments? Okay. Notes payable. As I've said, a note is a loan. And if it's payable, that means we need to pay it back, right? As opposed to a note receivable where somebody needs to pay us back. This is where we borrowed money and we need to pay them back. So it's a note payable. There is principal. There's the principal is what? Who can tell me? What does the principal represent in the note? It's the amount that we owe. Okay, it's either the amount of money we borrowed, or let's say we have a supplier that allowed us to make a purchase by signing a note. Instead of an account payable, we have a note payable. So we got a product or service, and in return, we signed a note promising to pay them back a certain amount. So the principal is the amount that we initially owed. On top of that is going to be any interest, because that's the difference between notes and accounts payable. Note payable, there's interest. As it says here, interest justifies the loan risk. Why do banks charge us interest? Well, it allows them to make a profit, right? Because that's their primary business. But it also offsets some of their risk because there's a chance that we don't pay them back. So they calculate that in. They charge enough interest to both cover those people that don't end up paying them back and give them a profit. But both parties have to agree that they want to sign the note, right? If you are being offered a note with crazy interest, say 20% or something, you might want to think if you have other options, because that's a pretty high interest rate. But if you agree to it, then you're legally bound and you have to pay that interest. Now, the terms of the note can differ. Again, it's whatever is agreed to by the two parties. But as far as when the principal payments have to be made, in other words, when you have to pay back the original amount that you borrowed, when you have to pay the interest, how much interest you have to pay, all of that is specified in the note itself, in the document that you both signed. So whatever interest rate you agree to, in this case we see 9%, to figure out your interest payments, you take the principal, the amount that you originally owed, multiply it by the interest rate, which again is annual. And then, in this case, if you're only trying to figure out interest for 1 month, you would multiply by 1 and divide by 12. So the 1 is for 1 month, and the 12 is because there are 12 months in a year. And remember, this was an annual interest rate. So if you were trying to figure out the interest that's going to be owed for 1 year, it's a lot easier. How would you do that? It would just be principal times the interest rate, right? Because it's an annual interest rate. But if it's for any period shorter or longer than a year, what you do is principal times the interest rate times the number of months and then divide it by 12. And that'll tell you how much interest covers that period. Okay, so that's a formula that we will be using in this chapter. Any questions? Sure.
So, for example, 5 years, 1,000 times 10 times 5. So
you could do it like that. If you were going to do it by months, it would be times 60 months divided by 12. Right? And 60 divided by 12 is the same as 5. right? So you can do it either way. All right, any other questions? Okay. So as I mentioned earlier, if you have a long-term note payable, oftentimes some of that is due this year. And so what we see here, if this is the total that's due, $100,000, but only 18,000 is due this year, that's the current portion. And the other 82,000 that's due after this year is the long-term or non-current portion. So on the balance sheet, you would see $18,000 under current notes payable or short-term notes payable, and you would see 82,000 under long-term notes payable. Because remember, in the balance sheet, we can separate out current and long-term, both for assets and for liabilities. Okay, here's an example. Bakery takes out a $100,000 loan. Remember, I specified that the two parties, the borrower and the lender, agree on the loan terms, right? So in this case, it says that the principal is going to be repaid in equal payments of $10,000 for 10 years. The bakery gets $100,000 up front, pays $10,000 a year for 10 years. That repays the principal, but it doesn't do anything for the interest, right? The interest is separate. So it says the payments are going to be made on July 1st each year. The interest is 7%. That is the annual interest rate. The loan was taken out on July 1st, which is right in the middle of the year, right? And this company's accounting period ends December 31st. Okay, so that means that at the end of the first year, right, they took out the loan in July, God bless you. Now it's the end of December. How much interest has accumulated? Only 6 months worth, right? Only July through December. So in their accounting records, where they have to calculate how much interest expense they can count, the company would say, okay, we took out a $100,000 loan at a 7% interest rate. This year, we only have 6 months of interest expense, July through December. And we have to divide that by 12 because there are 12 months in a year, and that's an annual interest rate. And so that tells us our interest expense for this year was $3,500. So that's how you would apply that formula that we learned. Any questions? All right. Taxes payable. It says here that companies can collect taxes on behalf of employees and customers. So what tax do companies collect on behalf of customers? What are they talking about? When have you ever had a company collect taxes from you?
Sales tax.
Sales, if you're a customer, it would be sales tax, right? A lot of items we purchase, most physical items are going to have a sales tax associated. So when you purchase, you're usually expected to also pay the sales tax. Tell you a little, it's not really a secret, but something a lot of people don't realize. It's not technically your requirement to pay the sales tax. It's the seller's requirement to pay the sales tax. But they expect you to give the money to them so they can send it in, right? If they didn't collect sales tax from you, that's fine. But they still have to pay it, right? So they typically pass that cost on to us. If they didn't, that would cut into their profits, right? So you can understand that's why they expect us to pay the sales tax to them. But if they've collected sales tax, they don't keep that money. they have to send that in here in California to the franchise tax board. They have to send that money to the state. I don't remember if it's monthly or quarterly. Does anybody know how often you send sales tax in? Monthly or quarterly? So the government wants their money, right? And the company's just collecting it and then sending it off. So in the meantime, they have sales tax payable. They collected the money from you, but they have a liability to send that in to the state of California. Now, some of that money doesn't go to the state. When the state gets it, they give some of that money back to the counties and the cities, depending on, every county can set its own sales tax rate. Every city can do that. So if you bought something here in Salinas, some of that money that the company sends off to the state stays with the state. Some of it might get sent to the county, and some of it might get sent to the city. Because if every company had to send it 3 different places, that would get kind of complicated. So the state does that part. But then what about employees? Somebody mentioned employees earlier. What tax does a company withhold from its employees? There are actually quite a few. In general, they're called payroll taxes. But it would include federal income tax, state income tax, Social Security, and Medicare. Maybe others, but definitely those 4. I guess short-term disability, I don't know if that's technically considered a tax, but that would also be withheld here in California. So same thing. The company withholds it from the employee. You don't have any control over that. You have a little bit of control. When you get a job and you fill out a W-4 form, that tells the employer how much to withhold out of your paycheck for your federal income tax. So you can control that to some degree, but if you pay less tax during the year, you're just going to pay more when taxes are due, right? So ultimately, you end up paying the same amount either way. But in the meantime, your employer, by law, has to withhold these taxes. Unless you're exempt, but most people aren't. And that means they have a payroll tax liability. They have to then send that money off. The federal tax money goes off to the federal government. The state goes to the state government. And that's how the company meets its liability. That pass? Okay, so here's an example with sales tax. You buy a $50 pair of shoes. If the sales tax is 8%, that means the store collects $54 from you, right? 50 is for the company. The $4 is sales tax that the company holds on to for a period of time, but then it has to send it in to the franchise tax board. Right, so any questions or comments on taxes payable? Right, oh, here's a receipt. We can see somebody, looks like they had a party. They bought all these party products and services. And, some of those maybe weren't taxable and some were. But overall, their bill was $400 and change. Wisconsin sales tax, I guess this happened in Wisconsin, came out to $22.70, and so that's the total that they had to pay, right? So if you look on your receipts, you'll see the same thing. Now, there are some cases where you don't get charged a sales tax. Anybody think of something you paid for and you didn't get a sales tax? Typically, services. You don't have to pay a sales tax on services, but most products you do. I don't know what the rule is here in Salinas. I know there are some cities where if you go to a restaurant and you get takeout versus eating in the restaurant, one is taxable, one's not taxable. I don't remember even which is which, but it just kind of depends. But in general, products are usually taxed, the sales tax. Services typically are not. All right. Journal entries. Here we've got an example. This company bought $12,000 of soccer equipment from a manufacturer. We see the credit terms here, and we see the journal entry. They got inventory. Sometimes you'll see it listed as merchandise inventory. Here they just put inventory, that's fine. And they have not paid, right? So they have an account payable. Notice that the credit terms were included here in the notes. So that they need to go back and see what were the credit terms, they've got it right there in their journal entry. Accounts payable, we know, are liabilities, right? And liabilities increase on the debit side or credit side? Credit, right? They're not part of deal. So when they go up, we credit. And when they go down, that's when we debit. So here, they make their payment, their account payable goes away. What do you think happened here? Why is there both inventory and cash in this transaction when they paid off their liability? Obviously, they had to use cash. But why does it also say inventory? That's right. They paid within that discount window, right? They had 10 days, and that would give them a 2% discount. So from August 1st, that gives them till the 11th. They got it in on time, so they get that 2% discount. How is that 2% applied? 2% of what? The 12,000. Yeah, exactly. Whatever is their remaining accounts payable, that's what they get the 2% discount off of, right? So 12,000 times 2% is 240, and the difference is the cash they pay. You all know that already. This is just sort of review. See what's happening here. Oh, here they return $1,000 worth of the merchandise. Okay, so this is assuming before they made the payment, they return some of the merchandise. When they do that, their accounts payable gets a debit. Why would we be debiting accounts payable in that case? Not quite cash back, but they owe less, right? Because they haven't made a payment yet, right? So there's no cash to be returned. If they had paid cash and then returned the item, then they would get cash back. In this case, they haven't paid. So when they return $1,000 worth of inventory, so we see inventories going down with a credit, the accounts payable goes down with the debit. So how much do they owe at that point? Exactly, 11,000. 12,000 minus 1,000 is 11,000. And then they would get 2% off of that, right? Okay, so here we see that's what they originally bought. They returned $1,000 worth, so they had $11,000 worth of inventory. They got a 2% discount. So really, the cost of their inventory turned out to be $10,780. And that's why we would credit the inventory account when they get the discount, because it's reducing the cost of their inventory. What if they didn't pay within that discount window? No discount, right? Then they have to pay the full amount. Okay, you're the owner of a catering company, and you take advance payments from your clients. The Coopers have paid you $5,500 cash on March 25th. Record your journal entries for the initial payment and when the catering service has been provided on June 10th. Okay, so what would that look like? Two journal entries. The first one is when you got the money, right? Yeah, and the second is when you provided the services. For the first journal entry, when we got paid by the Coopers, what would we debit? What would we credit? Remember, it's a catering service, and we're getting paid up front, right? Before we've done any catering. So what would we debit? The cash. We got paid, we debit cash. What would we credit? What do we call it when we get paid, but we haven't done any work yet? Unearned revenue. Exactly. That's it. Debit to cash, credit to unearned revenue. Then when we do the work, what would we debit? Unearned revenue. Because now we've done it. So it's no longer unearned. And what would we credit? When we've done the work. Revenue. Right? That's it. So first transaction, debit to cash, credit to unearned revenue. Second transaction, debit to unearned revenue, credit to revenue. Now maybe it's called catering revenue or some other variation, but the basic idea is the unearned revenue goes away and we can now claim revenue. All right, and here we have an exercise. Okay, so let's take a look at exercise 5. Don't let me forget to start recording again after we do this, please. Okay, let's start here. So here, Sierra Sports is going to be providing uniforms for sports teams. The league pays in advance for the uniforms. And let's see, it's 20 uniforms at $30 each. So the company got $600 in cash. We debit cash, right? Have they provided the uniforms? No. So they have unearned revenue. Notice they added the word uniform, so it says unearned uniform revenue, right? But it's still unearned revenue. Then they provide the uniforms. So that unearned revenue goes away, and they can now count the revenue. Now that they've counted it as a sale, they can also count their cost of goods sold. Because remember, you can't have an expense for your products until you've got revenue to match it with. That was the matching principle or expense recognition principle. So now that we can count it as a sale, we also count, if we're doing the perpetual inventory method, cost of goods sold. And we actually reduce our inventory by the amount that we sold. Okay, what if they did not provide all of the uniforms at one time? What if they did half at one time and half another time? Well, then you just need to break it up into separate journal entries, right? So now they've got 300 of the unearned revenue that's gone away and 300 of revenue that's been earned, and half of the cost of goods sold and half of the inventory reduction. And then when they provide the rest of the uniforms, it would be another journal entry for the remaining half. Pretty simple. Here's another scenario. Let's see. There were terms of 5, 10, net 30. Oh, this is interesting. This is an interesting journal entry because the team and the company have come to an agreement that the team is going to pay later for the uniforms and the company is going to provide the uniforms later. So really, there is no product that's been delivered. There is no payment that's been received. It just promises on both sides, but it's still a journal entry. If that is the arrangement, that, hey, as soon as you agree, you now owe us the $600, even though we haven't provided you the uniforms yet. Both parties have just made a promise, right? And then the team makes a payment. So their account receivable goes away. They do not owe anything further. And now the company has to provide the uniforms. If payment was never received, then they could say, fine, we're never going to provide you with the uniforms. In fact, maybe we're going to sue you because you broke your promise. But then go through small claims court. It was kind of an interesting situation. In this case, the team was expected to keep their promise before the uniform company actually kept their promise. But both parties were expected to keep their promise. Okay, so here the league paid within the discount window. Since we are doing accounting for the uniform company, which is the seller, that's where we see sales discount. Right? If we were doing the accounting for the league, that was the purchaser, and they were using the perpetual inventory method, then it would be merchandise inventory, right? But for the seller, it's a sales discount. And then again, the company has to provide the uniforms and earn the revenue. There's another situation, they take out a bank loan for $360,000. Remember I said that the terms, whenever there's a note or a loan, both parties have to agree to the terms, right? They have to agree when the principal payments will be made, when the interest payments will be made, etc. So here they've agreed that the principal payments are going to be made every year over 20 years. So you would just divide 360,000 by 20, and you get your annual principal payment amount. There are other ways to do it. Like you can amortize, but we'll get into that in a future chapter. I don't think we did some amortization for the depreciation chapter, but there's a loan amortization process I don't think we've done yet. So we'll get to that later. So for now, it's just really simple. Just take the principal, the amount that was owed, divided by the number of years. And that's the annual principal payment. The interest, on the other hand, is 9%. Now, again, the interest rate is an annual interest rate, so 9% per year. If it's simple interest, you could just say it's 9% of the principal and you pay that same amount every year. What often happens in loans is as you pay the principal down, you multiply the annual percentage rate times the remaining principal, how much principal is left. That means you end up paying less interest every year. It all depends on how the loan is structured. Here it says the interest accumulates every 3 months. So you would have to figure out, okay, 3 months have gone by. We want to figure out how much interest has accumulated so far. We take just the same formula we saw before. We take the principal times the annual interest rate times 3 and then divided by 12. And why would it be 3 in this case? That's right. A quarter means every 3 months, right? You take a year and you divide it into quarters. Each one would be 3 months in length. So exactly, that's how we would calculate the interest. All right. So interest for the first quarter. Again, principal times the interest rate times 3 divided by 12. This is how the company that borrowed the money would journalize the interest. Would say, okay, a quarter has gone by, 3 months have gone by. So that means we have accrued $8,100 of expense related to interest. And if we haven't paid it, we also have interest payable. Okay, so interest expense is the expense, interest payable is the liability. So they're two separate things. Okay, here's their annual principal payment. So when they make a principal payment, the note payable gets decreased. So again, if we take $360,000 of principal, the original loan amount, divide it by 20 years, comes out to $18,000 a year. So every year when they make their payment of $18,000, the note payable goes down by $18,000. After 20 years, what would be the balance in their note payable? 0, right? They would have paid it off. But note that it's completely separate from how the interest is calculated. So here they're paying a full year's worth of interest. Remember when we calculated interest for each quarter, it came out to $8,100. But if they don't have to pay it until the end of the year, and then they're going to pay all 12 months of interest at one time, then it would be 8,100 times 4 quarters, right? Which would come out to 32,400. Or another way to think about it, principal times the interest rate would come out to the same amount, because it would be the annual full year's worth of interest. Now, some companies calculate interest on a daily basis. They want to make sure they get every penny out of you that they can. And sometimes it's compounding interest. So any unpaid interest then gets charged interest. So they can be really sneaky about how they process and calculate interest. It became a big problem. I don't know if I've mentioned this before. I think I might have. At one point, the idea of annual percentage rate was presented as the solution. To keep lenders from confusing us with all these different interest rates or these complicated calculations, they have to tell us the annual interest rate. So we know how much interest we're paying in a year. And that's abbreviated APR, annual percentage rate. So in this case, it's pretty simple. Just take the principal times the annual interest rate, and that's exactly how much the company has to pay. And when they pay it, then that interest payable goes away, and of course they pay out cash. All right, let me see what time it is. 2:11. Okay. All right. We're about halfway through the chapter, so we're doing pretty well, which is good because, again, we're going to have guests and our discussion that we're going to do on Wednesday, in case you weren't here earlier. So it's good that we're ahead of schedule here. All right, so here's a balance sheet. Now notice on the balance sheet, there's some notes payable, and they're divided into current, right? Current liabilities and long-term. And as I mentioned, one loan that's long-term could have a current portion. So it ends up being split between the two sections. Right? The current portion is what has to be paid this year. The long-term portion is what has to be paid after this year. All right, here we have sales tax payable. The sports company buys some soccer equipment, and there's a 6%. No, I'm sorry, they sell it. No, wait, they buy it. Let me read this, figure out what's going on. They buy it, Oh, and then they sell it. I see. That's why I was confused. They buy it and then they sell it. Okay. So they sell the soccer equipment. When they do, they collect the sales tax from their customer, right? That's what I said is the standard practice. So if it was an $18,000 sale and the tax rate for sales tax is 6%, just multiply the amount of the sale times the tax rate, and that's how much sales tax they collected from their customer, right? So then when they actually oh, that's interesting. Oh, yeah, okay. So this is what the customer paid them. The customer paid them the full 19,080, covers the equipment plus the sales tax. Okay, it makes sense. But then the company would also, if they're using the perpetual inventory method, would also record cost of goods sold and inventory reduction. Okay. But they've got a liability. The company has to send that sales tax money to the state of California or wherever, whatever state they're in. So here's where they actually send off the tax payment. So the payable goes away. And they, probably they would have transmitted the payment electronically, right? So it's not literal cash, but still from an accounting standpoint, we just call it cash. All right. Yeah, okay, I remember this one. So we make a purchase. We buy 1,000 units at $1.25 each. $1,250 of boxes that we just purchased. And if we pay within 10 days, we'll get a 5% discount. Let's see, if we made the purchase on the 3rd of April, we paid on the 11th, and the terms were, we had 10 days, we got the discount, right? 3rd to the 11th, that's only 8 days. So we get the 5% discount. So what we have to do is journalize the original purchase, and then we journalize the payment. Let's start with the purchase. What would we debit the purchase? Which account? What did we get? Okay. Yeah. I think merchandise inventory. We bought some boxes, and we are a shipping and packaging facility, so that would be part of our inventory, right? Yeah. We count it as merchandise inventory. If we were in some other line of business and we're buying boxes, then maybe it's a supply. But since we are in the packaging business, we might resell these boxes to customers, and that makes it inventory. Okay. So we debit merchandise inventory, but we didn't pay right away, right? So what would we credit? Accounts payable? Correct. Okay. Then when we make the payment, what do we debit? Accounts payable. And what do we credit? Considering that we got a discount. Well, again, we're the buyer, so merchandise inventory. Right idea, right? That's how we would journalize the discount. And how do we pay? Cash. Okay. All right, so I think you all got the idea. Let's move on. A new concept, contingent liabilities. So I mentioned this briefly earlier. It's when we expect we might have a liability. It's reasonably possible that we'll have a liability. Then we do have to disclose that information to our stakeholders. Sometimes we actually have to include it in our financial statements, sometimes we don't. As far as an actual calculation, but in most cases, we do have to at least include a note in our financial statements saying that we might have this liability. So here's some examples of what sorts of things we're talking about. What if we think we might lose a lawsuit? By the way, you might know it's a historic day. Today is the first day of a trial, a criminal trial of a former US president, right? That's never happened in US history. It's going to be a while before we know the results because it's a whole process. Today, they're just beginning the jury duty selection, but it'll be interesting to see what happens over time. But let's say you're a company that's possibly going to have to pay some legal damages. You might end up losing a lawsuit and you have to pay somebody. That's information you might need to disclose in your financial statements, either including it in your calculations or at least as a note. What if you sell your product and you provide a warranty, which most products have some sort of a warranty? Well, there might be a cost to you to honor those warranties. That's something you also might have to disclose. What if you are an insurance company and it's possible that somebody will file some claims and you're going to have to pay out those claims? This is another, at least for me, this is a relevant topic. I was sitting at a red light. I don't know if you know, I think it was Canyon Del Rey and Del Monte over in Seaside. Just sitting there, minding my business, waiting for the light to turn green. I remember there was something I wanted to write down on my phone. So I looked down, I'm recording it on my phone. All of a sudden, boom, somebody hit me from behind just yesterday. Fortunately, it wasn't that hard. You know, I don't think I have any injuries or anything. And fortunately, well, this is what happened. So, you know, the light's still red. You know, the guy's behind me. And I'm thinking, okay, what am I going to do? I don't want to tie up traffic and sit here in the middle of the road. It's not that bad of an accident. I'm just going to pull over and then hopefully he pulls over too. We can exchange insurance information. It's clearly his fault since he hit me from behind. But I pull over into the closest parking lot, which is, I think, Embassy Suites right there. And I don't see him. And I'm like, oh, hit and run. He took off. But I was wrong. It just, I guess, took him a little while to turn around or something. He did end up pulling in. We exchanged information. Really nice guy. He was really shook up. And you know, he apologized profusely, but looks like I'm going to need a new bumper. Oh well. Could have been worse, right? Could have been a lot worse. But if I file a claim, my insurance company's, actually probably his insurance company, is going to have to pay out that claim, right? Because he was at fault. So if you are an insurance company, you can expect you're going to be paying out some claims. Or maybe you're planning to go through a bankruptcy and there are costs involved with that. And you might not be repaying all of your debts. And that would be something you would need to make known to your different stakeholders. So these are all contingent liabilities. And we're going to learn how to deal with them, when to journalize them, and when to just include a note. Okay, this is going to be a really useful table for you because it can get a little hard to remember the 4 different scenarios here. When we're dealing with a contingent liability, we have to think about how likely is it that this will occur? And can we estimate the cost? Okay. If it is something that is likely to occur, for example, we're in a lawsuit and we think we might lose. It's reasonably possible that we're going to lose. Okay, as opposed to we're in a lawsuit and we're pretty sure we're going to win, right? That'd be a different situation. But if we think it is probable that we're going to lose and we can estimate what the damages are going to be, then we go ahead and we actually do a journal entry. That would be the only case where we would journalize it because we think it's going to happen and we can estimate the amount. Now, maybe we're wrong, right? We can always adjust it later if it turns out that we were wrong. In addition to journalizing it, we would have to include a note explaining it in our financial statements. To say, okay, there's this lawsuit, we think we're going to lose, and this is how much we think the damages are going to be. On the other hand, what if it's probable that we're going to lose, but there's really no way we can estimate what the damages are going to be? Well, then there's nothing we can journalize, right? We don't have any idea what the costs are going to be. Then why journalize anything? So it's not going to then be a journal entry, but we're still going to include a note on our financial statement explaining the situation. Because our stakeholders, our investors, and anybody else looking at our financial statements, they have a right to know that we have this contingent liability. What if it's reasonably possible, like it could go either way? God bless you. Maybe we'll win, maybe we'll lose. Well, we still have to include it in our financial statements as a note. Only if the chances that we lose are remote, like really slim chance that we're gonna lose. In other words, we're like 99% sure we're gonna win. In that case, not only do we not have to journalize it, we don't even have to put a note in the financial statements. Okay? So these are the 4 different ways we could treat a contingent liability. And again, if you get confused about it, you can refer back to this table. Are there any questions at this point? Okay. All right, so here's an example. Remember that a warranty is a contingent liability, right? If the company offers a warranty, they might have costs associated with that. So in this case, this company sells these soccer goals. Not the goal, like not when it got kicked in, but the actual, like, the metal goal. So they expect that they're going to sell 500 of them. And looking back at their past sales, they find about 5% of them have to be repaired. I don't know why. Maybe they're not using very good material or something. But if that's the case, and the average repair is $200, and they offer a 3-year warranty, well, now they can calculate what's the estimated cost for the warranty. Now, the reason we have to do this, again, goes back to that expense recognition principle. If we made the sales this year, and we have some warranty expenses associated with these products we sold, even if those expenses are next year or the year after, because the sale was made this year, we need to count that estimated expense this year. In other words, we have to match that expense, even though it's an estimate, with the revenue in the same year. So we have to estimate that warranty expense, and then again, if it's wrong, we can always revise it, right? So if you take 500 goals, 5% needing to be repaired, that comes out to 25 goals, times a cost of $200, that means $5,000 of warranty cost. So in the year that they sold those goals, they count that warranty expense that's estimated, and then they credit allowance for warranty expense. Does that remind you of anything? Remember we had allowance for doubtful accounts, right? When we had to do our bad debt estimates. I think we covered that already, right? Yeah, okay. Same idea. That allowed us to count our bad debt expense in the year that our customers owed us the money, even if we weren't expecting to collect it until the next year. So same idea. We count the warranty expense, in the year we made the sale, even though the customer has 3 years to file a warranty claim. And the way we keep track of it is in the allowance for warranty expense. So every time there is an actual warranty claim that we honor, we would then debit allowance for warranty expense. And if we had estimated it perfectly, then at the end of the period, that $5,000 credit would have all been used up by 5,000 of debits, and it would be a zero balance. Right? And if we didn't estimate perfectly, we would see we have somewhat of either a debit or credit balance at that point. So here, the company has estimated they made repairs of $2,800. So that's what I was just saying. Now they debit allowance for warranty expense for the actual cost of providing warranty services. Right, so now if we went to the allowance for warranty expense account, it would have started with a $5,000 credit, and here it got a $2,800 debit. So it's gone down. And in this case, the expense was they used some of their inventory to repair the goals. So it turned out to be a $2,800 credit of their repair parts inventory. In other cases, they might credit a different account. So it just depends. Oh, and here we have a problem. Okay, so I'll pause the recording again. Oh, we only have 10 minutes. That's about a good amount of time. Let's go ahead and work on this problem. Number 7.